They thought the worst was over. After January's brutal crash from $121 down to $78, retail silver holders had survived. They had held, they had watched the blood on their screens, and they had not sold. And silver had climbed back, slowly, painfully, back toward 85, toward 90, toward the levels that made the thesis feel intact again. And then March 19th, 2026 happened. In the early hours of the New York trading session on March 19th, 2026, precious metals markets experienced a historic flash crash. Silver cratered more than 12.5% to touch $67.84. The sudden collapse caught traders off guard, especially as safe haven assets typically rally during periods of geopolitical instability, which reached a fever pitch that morning following reports of energy infrastructure attacks in the Persian Gulf. $67.84. Silver touched $67 on March 19th, 2026. That is the $65 crash the headline references. That is the number that wiped out another wave of retail investors who had survived January, who thought they had already paid their tuition to the silver school of hard lessons, and who got hit again. Harder this time. Because this time they were not prepared for it. This time they thought the worst was behind them. Welcome to Light Finance. And today I am going to show you the complete picture of what happened on March 19th, why it happened, and why the people who understand the mechanism rather than just the price action are the ones who are still positioned for what the fundamental data says is coming next. Stay with me, because this one is different from January, and the differences tell you something critical about where silver goes from here. The flash crash of March 19th, 2026 was not a rejection of silver's value. It was a casualty of a perfect storm, a hawkish Federal Reserve, a sudden energy-driven inflation shock, and the mechanical nature of algorithmic trading. Three forces, all hitting simultaneously, all pointing in the same direction. And not one of them changed the structural supply-demand picture that drove silver from $30 to $121 in the first place. Let us go through each force in sequence, because the sequence matters. And understanding it is what separates the investors who see this crash as a catastrophe from the investors who see it as the most important data point of 2026. Force 1, the Federal Reserve, Federal Reserve Chair. Kevin Warsh, recently appointed to lead a more aggressive anti-inflationary campaign, signaled that the central bank would maintain interest rates at the 3.5 to 3.75% range for the foreseeable future, dampening hopes for any monetary easing in 2026. As the US dollar index surged past the 100 mark, gold breached the critical $4,800 support level. Kevin Warsh, the man who called crypto speculative excess, the man whose nomination alone sent XRP down 15% in a single session. Now officially the Fed chair, and his first major signal to the market was exactly what the bears had feared. No cuts, all higher for longer. Dollar strength. And dollar strength is the most direct headwind silver faces in any time frame. The US dollar has historically acted as a barometer for gold and silver prices typically moving in the opposite direction. Dollar up, silver down. That is not a theory. It is a 40-year documented relationship. And on March 19th, the dollar surged, and silver responded exactly as the historical relationship predicts. Force 2, the Middle East energy shock. Reports of energy infrastructure attacks in the Persian Gulf reached a fever pitch that morning. The immediate challenge remains the threat of further energy warfare in the Middle East, which could trigger more margin call-driven liquidations if oil continues its parabolic rise. Here's the counterintuitive dynamic that caught retail investors completely off guard. Geopolitical shocks should help silver. Safe haven demand should push silver higher when the Persian Gulf is under attack. That is what the thesis says. And under normal market conditions, conditions where leverage is moderate and liquidity is deep, that is what happens. But March 19th was not a normal market condition. Between 9:01 a.m. and 9:30 a.m., the gold order book saw a staggering 98% drop in depth, allowing a vacuum of sell orders to drive the price down in minutes. 98%. The order book was empty. When the algorithmic selling started, there was almost nobody on the other side, no buyers. No market makers willing to catch a falling knife in a market where oil was parabolic and the Fed had just signaled higher for longer and the dollar was surging above 100. The liquidity vacuum turned what should have been a safe haven rally into a liquidation cascade. With volatility spiking, sales were amplified by risk limits, margin calls, and volatility control strategies. Silver being thinner and more speculative magnified the stress as positions had become especially crowded. Right here, before I show you the most important part of this story, if Light Finance is giving you the analysis that mainstream financial media is not giving you, hit that like button right now and subscribe. Because the follow-up to this crash, what the institutional money is doing right now as retail capitulates again, is the most important video we will publish this week. Subscribe now, hit the bell, and let us keep going. Force 3. The algorithmic cascade. This technical breakdown triggered a cascade of automated stop-loss orders. The flash nature of the move was exacerbated by margin calls across multi-asset portfolios. Every retail silver investor who had set a stop-loss below the recent support levels, and most of them had, because that is what every trading guide tells you to do, had their position automatically sold the moment that level was touched. And every automated stop-loss that triggered pushed the price lower, which triggered more stop-losses, which pushed the price lower still. As prices fell, margin calls intensified, pushing traders to sell into weakness rather than wait for stabilization. What might have been a deep correction quickly turned disorderly as forced selling fed on itself. Disorderly. That is the technical word for what thousands of retail investors experienced on March 19th as they watched their positions get liquidated in real time. Their stop losses triggered not at the price they set, but below it. Because in a market where the order book drops 98% and algorithmic sellers are hitting bids simultaneously across thousands of accounts, there is no orderly execution. There is a gap, a price gap between where your stop was and where your sell actually filled. And in that gap, in the distance between $67.84 and whatever the next bid was, retail investors lost money they cannot get back. Now here's the question that matters most, and this is the question that light finance exists to answer honestly. Did March 19th change the fundamental silver story? Is the supply deficit gone? Are the solar panel manufacturers suddenly sourcing their silver from somewhere new? Did the 6 consecutive years of demand exceeding supply suddenly reverse because Kevin Warsh gave a hawkish press conference? Market opportunities may emerge in the coming months for dip buyers who believe the industrial demand for silver driven by AI infrastructure and solar expansion will eventually outweigh the current liquidity concerns. Eventually outweigh. The industrial demand story is not gone. It is being outweighed temporarily by liquidity concerns, by margin requirements, by dollar strength, by algorithmic trading that does not care about supply deficits or solar panel demand projections. The machines sell because the stop loss was set at a certain level, not because they read the Silver Institute's deficit report and concluded the thesis was wrong. This was not a routine sell-off. Instead, it marked a structural failure fueled by reckless leverage. Silver traded more like a speculative tech stock than a historic store of value. Margin calls spread rapidly, while algorithmic funds accelerated the decline by targeting stop-loss levels and forcing prices lower. The real cause was margin exposure, not monetary policy. Margin exposure, not monetary policy, not supply demand, not the fundamental thesis being broken. The people who held silver with physical metal, with no leverage, with no stop losses, with no margin accounts, felt zero of the mechanical pressure that wiped out the leveraged traders on March 19th. Their metal is still in their possession. Their ounces did not change. The paper price changed. Their ounces did not. Leveraged futures traders experience immediate capital calls when margin requirements increase, facing forced liquidations if unable to meet new collateral demands. Institutional hedgers typically possess sufficient capital to weather margin increases, but may adjust hedging strategies based on changing capital efficiency considerations. 2 different experiences of the same crash. The retail leveraged trader, wiped out in the first 30 minutes of the New York session on March 19th. The institutional hedger, with sufficient capital, adjusting strategy, absorbing the volatility, waiting, and buying, because the institutions were buying on March 19th. The liquidity rupture has left institutional investors scrambling to recalibrate their portfolios. Recalibrating is not the same as fleeing. Institutions that manage pension funds and sovereign wealth endowments do not flee silver because of a 12% flash crash on a single day. They recalibrate their entry. They update their cost basis. They buy the panic that retail investors are selling. Silver investors should carefully read the sections detailing post-financial crisis periods and the Hunt brothers' boom-bust cycles. Changes in margin requirements and rules triggered mass liquidations of silver, resulting in an abrupt reversal of fortunes. Such actions are unpredictable and happen extremely fast. At its core, this provides yet another lesson on the high price that leverage can inflict on investors. When the market for an asset becomes highly leveraged, the risks increase markedly. The lesson is identical from 1980 to 2011 to January 2026 to March 19th, 2026. Silver runs, leverage builds, margin requirements rise, forced liquidations cascade, retail gets wiped out, physical holders survive, and the institutional buyers who absorbed the panic selling are positioned for the next leg of the fundamental story. Silver is now in a price discovery phase following the breakdown of prior support zones. Immediate support sits at the $78 to $80 area. Downside risk exists if a sustained break below 78 exposes a test of the 75 psychological level. Any rebound is likely to face selling pressure near 85 and again around 100 where prior momentum peaked. This is the technical roadmap from here. 78 to 80 is the immediate floor. If it holds, and the institutional buyers who stepped in at 67.84 have strong incentive to defend it, the path back toward 85 and then 100 opens up as the leveraged overhang clears. If 78 breaks with conviction, the 75 level gets tested next. If you're buying physical gold or silver for long-term wealth protection margin requirements, do not directly impact your holdings, but they can absolutely influence short-term price action. Futures markets set global benchmark prices. Leverage drives volatility. Margin hikes reduce leverage. Reduce leverage. That is what March 19th did, painfully, violently, unfairly to the retail investors who did not understand that their stop-loss orders were ammunition for algorithmic sellers in a 98% empty order book. But the leverage reduction that March 19th produced, the clearing of the speculative froth that had rebuilt since January, is the same process that sets up the next sustainable move. Less leverage means less vulnerability to the next margin hike. Less leverage means the next catalyst, a Fed pivot signal, a China export control escalation, a COMEX delivery default, hits a market that is not already stretched to breaking point. Investors should move forward with a focus on liquidity risk rather than just geopolitical risk. The events of March 19, 2026 serve as a stark reminder that in the modern financial ecosystem, no asset is a guaranteed safe haven during a liquidity vacuum. Liquidity risk. That is the concept that every silver investor needs to carry with them after March 19th. Not geopolitical risk, not supply deficit risk, liquidity risk. The risk that when markets seize up, when order books go 98% empty and algorithmic sellers hit every remaining bid simultaneously, even the most fundamentally sound asset gets taken down with everything else. And the only protection against liquidity risk in silver is the same protection it has always been. Physical metal, no leverage, no stop losses, no paper product that can be suspended by a government or margin called by an exchange. The thousands wiped out on March 19th were not wrong about silver. They were wrong about the mechanism. They held the right asset with the wrong structure. And the people who held the right asset with the right structure, physical silver in their possession with no borrowed money and no stop losses, are still holding, still positioned, and now holding at a much better average price than anyone who tried to use leverage to amplify the move that the fundamental story still supports. Drop a comment below right now and tell me honestly, did March 19th shake your conviction in silver, or did it clarify it? Because that question separates two completely different categories of silver investor. And I read every comment because your experience tells me exactly what content this community needs next. And if you know someone who got hurt on March 19th and is trying to understand what actually happened, share this video with them right now before you close this page. Because understanding the difference between a liquidity event and a fundamental breakdown is the difference between walking away from the best trade of the decade and staying positioned for what the supply data still says is coming. This is Light Finance. I will see you in the next video.